We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Bill Holter. He's a precious metals broker for over the last 20 years. How are you, Bill?
Good, Tom. Thanks for having me.
Always great to have you, Bill. And I'd like to start today by talking a little bit about, let's say, the foundation for the financial system, and that being debt. So when we have gone, through the interest rate cycle that we have seen, coming from effectively 0 to, 5.5%, does that start to hollow out the very foundation itself?
Yeah, it does. Because the foundation is debt. The foundation really to the world's financial system are U.S. treasuries. And I mean, you had a 10-year treasury that got, that's risen almost 4 percentage points at this point. And when interest rates go up, the value of treasuries, whether it's short-term, intermediate, or long-term, they all go down. Short-term obviously doesn't go down as much, but the 10-year and the 30-year drop dramatically as interest rates rise. So what that does is it shrinks the collateral, and what's holding the entire system up has been collateral. And I think you need to go back and you need to look. Interest rates peaked in 1982, and rates started coming down into 1986. Then the Fed started tightening. They tightened pretty aggressively in 1987, and we had the 87 stock market crash. They were tightening again in early 90s, and we had the sovereign debt crisis, the debt and currency crisis. Then in 1997, they were tightening again. We had the long-term capital management crisis, then the dot-com bubble, and then, of course, the 2008 great financial crisis. But understand that each time that the Fed tightened, they never went to or above where rates were in the previous cycle until this time. Mm-hmm. Interest rates now are back to where they were, I think, in 2001, 2002. So basically, if you look at real estate, if you look at, and you can look at stocks too, because they're discounted by the interest rates. But if you look at real estate, we're back now to where rates were in 2001, 2002. And the point I'm trying to get across is because rates are back to where they were then, where are prices? Prices are still more than double, triple, in some cases more than they were back in 2001, 2002. So there's an affordability crisis in real estate, and understand that real estate has been such a huge portion of the economy as far as building and all the ancillary jobs associated with that. So understand that these higher rates really do affect the real economy, not to mention the higher rates on all these banks, brokers, and insurance companies that have levered treasuries, levered debt. They've levered it. And on top of that, of course, every derivative has an interest rate assumption. So when rates go up, it hollows out, it hollows out the foundation to the entire system. And I mean, I look at this, and unless rates immediately start going down from here, and I don't see that happening, I think we have a complete collapse and meltdown directly in front of us.
Bill, when as we think about, let's say, the lag time that these interest rate hikes take to really work themselves into the system, I think we can point to, just even commercial real estate being one of those sectors of the system that seems like, a real issue, just teetering, ready to go. How do we how do we think about the lag time that it takes the interest rate hikes to affect the economy in this way? And are markets pricing them in at this point?
Well, the stock market's not pricing higher rates in. Real estate, you mentioned commercial real estate. I mean, look at the hotels that have turned over and have turned over for less than 50% on 2015's dollar. Less than 50%. I mean, there's hotels that have sold recently less than 50% of what the price was back in 2006. So I mean, it's already affecting the volume in commercial real estate and prices in commercial real estate, certainly affecting the volume in housing. So I mean, the interest rates, and just look at what happened back in March and April. We had 4 big banks blow up, and the assets of those 4 banks, a lot of people don't know this, but the assets of those 4 banks combined was greater than everything that collapsed, than the banks that collapsed back in 2007, 2008, 2009. So it's already a big deal, and it was becoming a big deal. And you could see that in the reverse repo market last fall. A year ago, the reverse repo market started to really struggle, and the Fed was having to put $100 billion a night into the reverse repo market because there was a liquidity crisis beginning. And then, of course, in the springtime, you had the banks, those 4 banks blow up. So it's already affecting the real economy. And it's just a matter of time until the equity markets reflect that.
Mm-hmm. So, Bill, you talk about this crash type scenario. What steps do you think people need to be taking in order to protect themselves at a time like this, where it seems like there are so many risks all around us?
Well, probably the most important thing to do, if you have stocks with a broker, you want to call your broker and get those stocks delivered to you. If you're going to hold them, get those stocks delivered to you in certificate form. Because a lot of people don't know this, that when you hold stocks at a broker in street name, it's on your broker's balance sheet. So if they go out of business, it will be years and years before you'd be able to get access to those. And I've read some things, and I think they're correct, that the clearinghouses themselves have been, by law, indemnified from taking your stocks that are in your name. They're in your name only as a benefit to you. The clearinghouses themselves are the actual owners of the stocks. And in a meltdown scenario, if the clearinghouses themselves go down, you're going to end up losing your capital. So the best thing to do is to have your stocks issued to you in certificate form. And I know I'm going to get a ton of questions on how to do it. You call your broker, you tell them you want the certificate. If they tell you it's going to cost you $500 per certificate, then what you do is you tell the broker to move the stock to the transfer agent. Once the stock is moved to the transfer agent, then contact your transfer agent. They'll charge you $10 or $20, something like that, to have the certificate itself issued. And once you have the stocks in hand, obviously don't lose them, because if you do, it's going to cost you 3 or 4% in the form of a surety bond fee to get those stocks replaced. But physical ownership of the stock is basically proof that you're an owner in the company. And it doesn't matter if your broker or clearinghouse or whatever goes out of business, you have a physical, if you want to call it a receipt. That's what your certificate is proof of ownership.
It's almost the idea, or along the same lines, of taking counterparty risk away from yourself by owning physical metals and holding them yourself, right?
Right. If you hold metal yourself, then there is no third-party risk. Doesn't matter who goes bankrupt. you're holding the metal.
Mhm.
Same with the stocks. It doesn't matter unless it's the company that you're owning. But as long as the company you own doesn't go bankrupt, you still have ownership and proof of ownership of whatever shares in that company.
Mhm. Bill, how do you view the role of cash in a scenario like that too? Is that, in a way, a sacrificial piece of capital that is going to lose value, but yet in certain scenarios makes sense to have on hand?
Once this thing breaks down, I think you will see cash. Once we get to the point where you don't have access through credit cards or debit cards for your bank account, once that happens, cash will probably rise in value for a couple weeks. And cash will probably work for a couple weeks, maybe 4 weeks. I don't know.
Mhm.
But at some point in time, for instance, a farmer is not going to give you a dozen eggs and take paper dollars for it, because farmers are smart enough to understand they're giving you something and you're giving them nothing. You're giving them pieces of paper with printed numbers on it.
How about the difference between, let's say, gold and silver? Do you look at one as more speculative than the other? Is one more of a savings vehicle? How do you view their roles as different, Bill?
Well, you'd have to say that silver is more, if you want to use the word speculative, than gold, simply because it's more volatile. It goes up faster and it goes down faster. Silver is the metal of the common man, and gold is the metal of kings, if you will. The reason you own gold is to get your serious wealth from here to the next system, whatever it's going to look like, intact, and you'd still have capital. Silver, you would use silver along the way for barter, but with the current ratio at 80-1, in other words, it takes 80 ounces of silver to buy 1 ounce of gold, it comes out of the ground at 10-1. So God's ratio is 10-1, man's ratio is 80-1. One of the two is wrong, and I think figure out which one's incorrect.
Mhm.
So what I'm telling you is, based on the ratio, silver should way outperform gold going into the next system. The only problem with silver is if you're talking about large amounts of money, you've got a storage problem. Whereas, I mean, you literally could put 500 ounces of gold into a computer bag, weigh, I don't know, 35, 40 pounds or whatever it is. And you're walking around with $1 million, in current dollars.
Mhm.
So, there's a portability problem with silver. There's a storage problem with silver, but it is very undervalued to gold. It should outperform gold drastically.
Bill, as we're talking about the idea of, let's say, the values of these metals, do you see let's say the waning value of the waning value and influence of the US dollar over time as one of the more sound ideas of why you want to own the metals?
Well, yeah, I mean, all fiat currencies are debasing. I mean, just go back 20 years ago. You were looking at gold at what, $300 an ounce, and silver at what, $4 or $5 an ounce. So as currencies have debased, that ounce of gold is still the same ounce of gold, and an ounce of silver is still the same ounce of silver, but it takes more dollars because they've been debasing the currency. So yeah, I mean, as the dollar debases and everything from a cup of coffee to an ounce of gold becomes more expensive in dollars or yen or euros or British pounds or whatever you're looking at, the best way to protect your purchasing power is with gold and silver.
So,
And Tom, one other thing I just want to mention. I mean, the reason you're looking at it from a debasement standpoint, I think it's better right now because of what we have right in front of us to look at gold and silver from a from a liability standpoint. They have no liabilities. Gold cannot go bankrupt. Silver cannot go bankrupt. But every currency on the planet can and probably will go bankrupt in some fashion, whether it be through non-payment or outright overprinting, because the debts that are too large to pay now will have to be paid, and there's not enough dollars, there's not enough euros, et cetera, out there, so they're going to have to print more.
Mm-hmm.
So there's going to be defaults all over the place, and the only two monies that cannot default are gold and silver.
Mm-hmm. Well, that's kind of what I was getting at, Bill, is the idea of, I think everybody in this community understands the idea of currency debasement, but, looking out a little bit further, do you think there's going to be a dramatic debasement to the US dollar or power struggle associated with the US dollar? Or is it going to be the same, chipping away, let's say 6% year over year purchasing power?
I think, well, obviously, you've had the chipping away for years and years. But I do think that the moment of revaluing gold higher is directly in front of us. Whether that happens because there's a failure to deliver, or whether that happens because China and Russia decide they want to revalue gold higher, I don't know what the event will be. But gold and thus also silver is going to be revalued higher because it has to. I mean, they've both been artificially depressed for years, and that suppression scheme is coming to an end. And I've said for many years that whether a default on COMEX causes the revaluation or whether a revaluation causes a default on COMEX, it doesn't matter. There's going to be a failure to deliver at some point.
Mm-hmm. Well, I mean, the idea of the COMEX failing is something that we've talked about lots on the show, and it's always up to the seller to dictate the settlement terms of the contract, is it not?
Right. There is writing, and of course the trolls will come out and say, oh, COMEX can never default because they can just pay money. Okay, so legally it's not a default, but if somebody demands their gold and they don't get gold, I don't care what you call it. You could call it any word or concept in the world. It's a default. Mm-hmm. If they don't deliver metal, and they deliver dollars or rice or whatever, it doesn't matter. That's a default. Mm-hmm. What that's going to do is it will drive gold and silver that people have in hand into hiding, because what COMEX would then be saying is that the dollars themselves are worth less than the gold or the silver that was supposed to be delivered.
Mm-hmm. Or that they don't have enough to be able to actually deliver because demand is so high at that time as well, right?
Right, exactly. Because the vaults don't contain that amount of metal. Exactly.
Mm-hmm. You and I have spoken before about the idea of a currency war. What do you see as the risk of a currency war escalating into a hot war?
Well, I mean, we've been in currency wars for years at this point. You have a hot war between Russia and de facto the United States, because we're obviously the ones supporting Ukraine. Do you believe China will not at some point invade Taiwan? I mean, there's no question about it that a hot war is one of the biggest risks worldwide. Every single day you go to bed and every single day you wake up.
Bill, a lot of times when we're talking about the differences between, let's say, China and the West, or the East and the West, we've seen a lot of gold flowing towards the East, China, Russia, this idea that the central banks have been buying in record amounts over the last year or two here. When there is a a possible revaluation of gold, whether it be China that decides that they're going to start paying a lot more for it, or whether it be the US that decides that, who ends up being the biggest beneficiary? Is it the person that goes first or the person that ends up having the most gold?
It doesn't really matter who goes first. It matters who has what. But I mean, even 3-4 years ago, I could have shown you on the back of a napkin that China has over 25,000 metric tons. And that's in comparison to the supposedly 8,300 tons that the U.S. claims to have. The U.S. has not audited their gold since, I think, 1956. And you've got to ask, well, why have they not audited? Their excuse is it's too expensive to perform an audit, which is complete horse shit. I mean, they spend, billions of dollars on trying to figure out the sexes of toads or something stupid like that. So for them to not want to spend 20 million or 40 million or whatever it costs to do the audit, it's a bogus reason. And the real reason is the 8,300 tons of gold is not there.
You believe that the gold isn't there, therefore the argument that the US would be able to remonetize its gold is completely invalid, right?
It's invalid because first off, the numbers, even if the US did have 8,300 tons, and I did this calculation, I think 3 years ago, if the US revalued the 8,300 tons versus, I think when I did the math, it was a 23 trillion or 25 trillion in debt that the US had, you had to come up with $125,000 an ounce. So now at this number of 32 trillion, you got to be pushing $200,000 an ounce. So it would be a ridiculously high number, but a valid number. My opinion is, the U.S. can revalue gold, but what they'd have to do in that instance is they would have to nationalize the gold mines in the United States, because that's where the gold is. It's in the ground, has not been mined yet.
So, Bill, do you think that the idea of an outright debt default or a debt jubilee is far more likely in that scenario then?
I don't think that there will be a debt default. Well, let me rephrase that. There's going to be a debt default, but it won't be for non-payment. They will just print whatever they need to print. And, if overnight they have to triple the money supply or quadruple whatever the number is in order to create enough dollars to make payments, they're going to do whatever they have to do. They will destroy the dollar in the process of paying the debt off. And because the debt in current terms is unpayable, it's too large.
So, Bill, as we're touching on the idea of the amount of currency in circulation, obviously the equation for monetary velocity that's one of the major parts of that equation. Does the idea of monetary velocity matter anymore? It seems to be a topic that I haven't heard discussed for some time now.
It does matter. And first, you should look at M2 money supply. M2 money supply has been dropping. It's been declining now for about 18 months. And that's never happened with the exception of going into the Great Depression in the 1930s. So the fact that money supply is declining at the same time interest rates are rising, which is requiring more money to make the debt payments, that's a problem. And what you're seeing for the first time in about 20, 25 years is it looks like velocity is turning higher. Velocity has basically done nothing but go down since the late 90s. And it now looks like it has turned. Whether that continues or not, we're only 2.5 months into that. But if it truly has turned, then what you're looking at is the beginning of the hot potato moment where no one wants to hold dollars.
So it's just a matter of seeing if that trend continues at this point or not, because of the idea of basically that self-reinforcing cycle where people don't want to hold dollars because they are starting to either lose faith in them or recognize the fact that they don't buy as much tomorrow as they buy today.
Right. And I mean, just look at oil. I mean, the petrodollar is dead. The petrodollar was created in 1973 when Saudi Arabia said that they would only take dollars for oil. Well, that's changed over the last couple of years. Saudi Arabia will now accept yuan. I believe they'll accept euros. They're not exclusively dollars. And a lot of these countries that had to buy dollars in the past in order to purchase oil no longer have to purchase dollars. And then that brings into question, what about the dollar reserves that they've built up? Do they want to hold those dollar reserves for future oil payments, or do they want to sell the dollar reserves and buy euros or buy yuan or what have you in order to make payment for oil? And I think that may be why velocity looks like it's turning higher, because you've got foreign sovereigns that are liquidating dollars because they don't see that they're going to be forced to own dollars in order to purchase oil.
Interesting. Yeah. So it's not just at a consumer level, it's also at a sovereign currency trading and energy trading level.
Well, yeah, most importantly, it is the sovereigns. I mean, yes, it's important, individuals, corporations, etc. But the big money is done, through sovereign trade, through trade. And if you go back 20 years ago, you probably had 70, 80% or more of global commodity contracts priced in dollars, and that's no longer the case.
Mm-hmm. Excellent, Bill. Well, unless you have anything to add, I think that's a good place to wrap up our conversation for today. Why don't you mention your new website and where people can get a hold of you?
Sure. Website's simple. It's just billholter.com. And you can reach me. There's a contact button on the website. If you want to contact me directly, you can go to my business email. It's bholter@hotmail.com.
Excellent, Bill. Thanks so much for your time today.
My pleasure. Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.